Are you afraid to miss out on wealth? Start investing in stocks. Here's how. Please like, subscribe, hit the notification button, and share this video. Also, check the links in the description. Before you buy your first stock, build a strong financial foundation. You wouldn't build a house on a shaky foundation, right? Same goes for your financial future. First, you need an emergency fund. Aim for 3 to 6 months worth of expenses. This is your safety net. Next, tackle high interest debt. Credit cards, payday loans. They eat away at your earnings. Pay them off quickly. Finally, get on a budget. Track your income and expenses. Make sure you're not spending more than you earn. Okay, now that we've got that solid foundation in place, it's time to get your learning on. Knowledge is power, especially when it comes to investing. The more you know, the better equipped you'll be to make smart decisions. Start by understanding the basics of how the stock market works. What are stocks? What are bonds? What are ETFs? Don't worry, you don't need to become a Wall Street wizard overnight. There are tons of resources out there to help you. One of my favorite books for beginners is The Intelligent Investor by Benjamin Craig. It's a classic for a reason. And of course, there are tons of great websites and YouTube channels like this one dedicated to making investing accessible to everyone. The key here is to be patient and consistent with your learning. The more you absorb, the more confident you'll become. Remember, knowledge is your secret weapon in the world of investing. Ready to start investing? Start with index funds. They're the training wheels of investing. A great way to get your feet wet. So what is an index fund? It tracks a market index like the S&P 500. You invest in a basket of stocks, providing diversification. Index funds have low fees, meaning more money for you. They're low maintenance and high reward. Now, I know what you might be thinking, but Craig, where's the excitement? Where's the thrill of picking individual stocks? We'll get there, I promise. But trust me, starting with index funds is the smartest move you can make as a beginner investor. Chapter 4. Step 4. Consistency is key. Embrace dollar cost averaging. Let's talk strategy. Keep investing simple and consistent. That's where dollar cost averaging comes in. Instead of timing the market, invest a fixed amount regularly. This could be monthly or per paycheck. It helps average out your purchase price and potentially reduces your risk. It's like a superpower against market volatility. Stick to your plan and let time do its thing. Chapter 5. Step 5. Play the long game. Patience is your superpower. Now let's talk about one of the most important concepts in investing: patience. Investing is a marathon, not a sprint. It's about building wealth slowly and steadily over time, not getting rich quick schemes. You see, the stock market is going to go up, it's going to go down, and sometimes it's going to feel like a roller coaster ride. But here's the thing. If you've done your research, you're invested in solid companies or index funds, and you're thinking long term, those short-term fluctuations shouldn't faze you. Remember, time in the market beats timing the market. The longer you stay invested, the more opportunity you have for your money to grow and compound. So buckle up, enjoy the ride, and trust the process. Chapter 6. Step 6. Don't put all your eggs in one basket. Diversify. Let's talk about risk management. One of the most important principles in investing is diversification. You've probably heard the saying, Don't put all your eggs in one basket. Well, it definitely applies to investing. Diversification means spreading your investments across different asset classes, industries, and geographic regions. Why is this so important? Because it helps reduce your overall risk. Think about it like this. If you invest all your money in one stock and that stock plummets, you're in trouble. But if you have a diversified portfolio, even if one investment takes a hit, the others can help cushion the blow. So, how do you diversify? It's easier than you think. You can invest in different sectors like technology, healthcare, energy, and real estate. You can invest in different countries and emerging markets. And you can even diversify within asset classes by investing in both large cap and small cap stocks, for example. Chapter 7. Step 7. Automate your investments and relax. All right, here's the final step, and it's all about making your life easier. Automate your investments. That's right, set it and forget it. Most brokerage accounts these days allow you to set up automatic contributions where a certain amount of money is automatically transferred from your checking account to your investment account on a regular basis. This is a total game changer because it takes the emotion out of investing. You're not second guessing yourself. You're not trying to time the market. You're simply investing consistently, no matter what's happening in the world. Plus, automating your investments makes it so much easier to stay on track with your financial goals. You're essentially putting your wealth building on autopilot. And who doesn't love a little bit of automation in their lives? Now that you've automated your investments, let's dive into stock sectors. Understanding sectors helps you make informed decisions. Start with technology, including Apple, Microsoft, and Google. These companies are known for innovation and growth. Next, consider healthcare, always in demand. It's a stable choice for long-term investments. The financial sector offers steady dividends. Lastly, consumer goods perform well, even in downturns. Diversifying across sectors balances your portfolio. Stay informed to make smart investment choices. Next, let's explore the healthcare sector. This sector includes companies that provide medical services, manufacture medical equipment, and develop pharmaceuticals. Companies like Johnson & Johnson, Pfizer, and United Health Group are major players in this sector. Healthcare stocks can be a stable investment, especially during times of economic uncertainty. The demand for healthcare services and products tends to remain constant, regardless of economic conditions, making it a more defensive play in your investment strategy. Whether it's cutting-edge biotech firms or established pharmaceutical giants, the healthcare sector offers a variety of opportunities for growth and stability. By including healthcare stocks in your portfolio, you can add a layer of resilience and balance to your investments. Stay informed about advancements and regulatory changes in this sector to make the most of your investments. Now let's talk about the financial sector. This sector includes banks, investment funds, insurance companies, and real estate firms. Companies like J.P. Morgan Chase, Goldman Sachs, and Berkshire Hathaway are key players in this sector. Financial stocks can offer good dividends and growth potential, but they can also be sensitive to economic cycles. Investing in financial stocks can be a smart move if you understand the economic landscape and can identify companies with strong fundamentals. For instance, banks often benefit when interest rates rise, while insurance companies may thrive in stable economic conditions. Real estate firms can offer a hedge against inflation, providing a steady income through dividends. However, it's crucial to stay informed about regulatory changes and economic indicators that can impact this sector. By including financial stocks in your diversified portfolio, you can tap into the potential for both income and growth. Remember, the key is to balance risk and reward by staying educated and making informed decisions. Now let's turn our attention to the consumer goods sector, another important area to consider for your investment portfolio. This sector includes companies that produce goods for everyday use, such as food, clothing, and household products. Think about the brands you use daily. Chances are they belong to companies like Procter & Gamble, Coca-Cola, and Unilever, which are well known in this sector. Consumer goods stocks can provide steady returns, especially for long-term investors. These companies often have strong established brands and consistent demand for their products, making them relatively stable investments. Whether it's the toothpaste you use every morning or the soda you enjoy on a hot day, consumer goods are a part of our daily lives, and investing in this sector can be a smart move. By including consumer goods stocks in your diversified portfolio, you can benefit from the stability and steady growth these companies often offer. So, don't overlook this essential sector when building your investment strategy. Let's not forget the energy sector. This sector includes companies involved in the production and distribution of energy, like oil, gas, and renewables. Companies like ExxonMobil, Chevron, and NextEra Energy are key players. Energy stocks can be volatile, but offer substantial returns. Investing in energy stocks can be a roller coaster ride, but the potential rewards are significant. The energy sector is crucial to the global economy, and demand for energy will only increase. Whether it's fossil fuels or renewables, this sector is vital. Including energy stocks in your portfolio taps into this vital industry's growth potential. Remember, higher returns come with higher risk, so stay informed about energy market trends. Balance energy stocks with stable investments to manage risk. Add energy to your strategy and power up your portfolio for the future. Lastly, let's discuss the utilities sector. This sector includes companies that provide essential services such as electricity, water, and natural gas. Companies like Duke Energy, American Electric Power, and Dominion Energy are key players in this sector. Utility stocks are often considered safe investments, providing steady dividends and stability. Because they supply essential services, utilities companies tend to be less volatile compared to other sectors. They offer a reliable source of income, which can be particularly appealing during uncertain economic times. Investing in utilities stocks can be a great way to add a layer of security to your portfolio while still participating in the growth of the market. Utilities may not be the most glamorous sector, but their consistent performance and dependable dividends make them a cornerstone for any well-rounded investment strategy. So, if you're looking for a bit of financial stability, consider adding utility stocks to your investment mix. You'll be powering up your portfolio with a steady hand that can help keep your investments on track through thick and thin. And there you have it, your beginner's guide to building wealth through stock investing. Remember, investing is a marathon, not a sprint. Stay disciplined, keep learning, and watch your wealth grow over time. It's not about getting rich quick. It's about making smart, informed decisions that will benefit you for years to come. And the best part, you don't need to be a financial expert to get started. If you found this video helpful, don't forget to like, subscribe, hit the notification button, and share this video. Also, Check the links in the description. And for more in-depth knowledge, grab a copy of Get Rich by Investing by Craig Smith, the CEO of CRAIGTRADER Companies and a seasoned investor with a finance degree. This book can help any level of investor become better and more professional. The link to get it is the first link in the description. Thanks for your support. See you next time.